Hi everyone, Corey here with the Cyclical Investors Club YouTube channel. And this week, other than the normal buy, sell, or avoid section of the video, I'm going to start off by talking a little bit about measuring returns. We just passed our 2-year anniversary at the Cyclical Investors Club Premium, and I'm a big proponent of measuring returns so that we know if what we're doing is working, but that's really difficult to do for a lot of reasons. There's no perfect way to do it, but I think there are ways to think about it to make sure that it makes sense for the type of thing, the type of investing that you're trying to do, okay? And I see a lot of people make mistakes or at least not really think about returns in the different ways that I think they should, the different angles they should probably be thinking about it. I basically think about returns in 3 different ways: absolute returns, relative returns, and risk-adjusted returns. Okay? So absolute return is basically just what was your return on the investment or the portfolio for a given time period, usually a year. It can be longer than that, obviously, but I mean, at the portfolio level, is really where I focus on this. Each individual stock return can carry some information with it, but you don't really get a full picture of how everything's working unless you have a full portfolio of stocks. Because if you have some stocks that are really conservative bets, and you match them with some that are more aggressive bets, if you just look at one of the aggressive bets maybe that didn't pay off, that lost money, that's not really reflective of the overall portfolio and what was going on there. So you have to be really careful about your sample size and how many data points that you have. Now my rule of thumb is I like to have about 30 data points before I make any kind of big judgments about whether something was successful or not. And that's one of the reasons I like to use an unconcentrated portfolio. If you only make a handful of bets, if one of them goes wrong, it could just be by bad luck. And that could really depress your portfolio returns, no matter how you measure them. And you could have a really good investing process, but you just didn't make enough bets for that process to pay off. Okay, so I'm not going to get into like math and statistics here, but 30 data points is usually kind of when I start to say, okay, we can really get some useful information in. Even if it's not statistically significant, you can gather useful information from it. Maybe even less than that. But if you think about the Dow 30, the Dow Jones Industrial Index, I mean, they've only had 30 stocks in there forever, and it's pretty much traced the results that you would get long-term over a bigger index. Okay, so let's start with just absolute returns, and that's basically your basic return over whatever the time period is. So with the Cyclical Investors Club, the last 2 years, each year we've returned about, the ideas have returned about 24% each year. So that's pretty good. I mean, but it's also useful to look at the relative returns to the market, and usually unless you invest in just one industry, the S&P 500 index is typically what people use, and I think that's a pretty good benchmark to measure against, and that's the one I've chosen to measure against. So then you look at the relative returns. Well, the first year of the Cyclical Investors Club, we returned about 24%, just short of a year because we started 2 weeks into January 2019. And the S&P 500 had a total return closer to 26%. So our absolute returns were very good, 24%, but our relative returns were a little less than what the market was. So that changed in 2020, where we returned a little over 24% again, and the S&P 500 only returned 18% or so total returns. So in that case, we had good absolute returns, and we also had good relative returns. And then if you combine the two together, we outperformed enough in 2020 that you can say over the course of 2 full years, we had good absolute returns and good relative returns. So those are the simplest and easiest ways at a glance to kind of see what's going on. The tricky part, I think, comes when we start talking about risk-adjusted returns, okay? So typically, what you see people usually use when they talk about risk-adjusted returns is volatility, okay? And this is where it's important to think, let's just say this is where I think differently about this than a lot of investors. For me, volatility is not really a good measure of risk, and a lot of this has to do with the time frame that we're measuring, okay? So if we take long-term returns, look at Berkshire Hathaway, okay? So basically they've returned 20% every year for 50 years or something like that. So once you get a time frame that's that enormous, risk adjusting doesn't really matter anymore. I mean, the risk has been built into those returns already. The risks happened over the course of 50 years and they still return 20% a year on average, okay? So you don't even need risk-adjusted returns if you have multi-decade levels of performance. But most people don't have, most money managers, most funds, nobody has, hardly anybody will say has 50-year track record, right? So it helps if you can measure the performance of your ideas in shorter time frames than these very long-term time frames. I would say like usually 2 economic cycles is enough to probably call something long-term. So definitely if somebody has been managing a portfolio since, say, the mid-90s through today, like 25 years, that's certainly enough. And maybe even it's enough. We had kind of a weird recession this time, and so I don't know how much we want to count that as a full cycle. But, if somebody had a 20-year track record right now, I would consider that long-term, or maybe 15 years. Okay? So, but anything less than that, we need to think about risk adjusting and how much risk a person was taking. Now, what I've seen is you don't even get any real solid return evidence in terms of someone's talent or the process that a person decides to use and how good it is until about 3 years in, and then you start to see some divergence between the quality of an approach or the talent of the investor or whatever. So I just gave 2 years worth of performance. It's not that that doesn't mean anything, it means something, but I wouldn't go and pick a money manager who had good returns for 2 years and just assume that those are going to be able to continue. You at least, I would say, need one full cycle, and 2, luck is so much more involved in the short term that less than 3 years just doesn't tell us very much, okay? But, so if long term doesn't matter, that leaves us basically with 2 more time periods that I care about, a medium term and a short term. Okay, so for short term, I think there it makes sense for volatility to be a decent measurement of the risk that someone's taking in their portfolio. If they have a lot of ups and downs in their portfolio, then they could be up at any given time period at the end of the year or 2 years or whatever, or they could be down. So what we're really trying to do is adjust for luck when we think about this. And so volatility can be a decent proxy over the short term of like a year or 2, maybe even 3 years. But the medium term of, say, like 5 to 10 years, that's where I think it gets a little tricky. And I just kind of thought of my own way to think about it and the way that I think about it, because I have to make judgments on the techniques that I'm using to find value in the market. So it's not just about judging other people, it's about me judging what I'm doing, okay? Sometimes I'm going to be unlucky, but if I'm unlucky too much, then I'm probably doing something wrong, all right? Or if my portfolio draws down too much, I could be doing something wrong. I might have been taking on a little bit too much risk or not have recognized a particular risk, okay? So medium term, in my mind, what I think of is how much average cash or cash equivalent, and we'll call that, say, easily accessible money, maybe less than a one-year treasury or less, like 3-month treasury type stuff. There hasn't been that much inflation lately, so in my mind, just saying cash is fine. But if we had a situation where you needed some sort of return in order to equal inflation, then it might be a little bit more than cash. But very short-term bonds or cash. How much of that are you holding in your portfolio on average? Okay. And if you take that, that can tell you how much risk you're reducing. Okay. So, for example, in 2019, I basically didn't have any cash. All right. So mostly fully invested. But in the end of February 2020, we went to a lot of cash. And normally I wouldn't have had as much available to go to cash, but that's just the way it worked out. So we were like 80% going into March cash at the Cyclical Investors Club. And we invested a big chunk of that in March. So after a couple months, basically we were at like a third cash. So for most of the year, and then we've reduced that now to slightly under 20%. Okay, so that's kind of the progression throughout the year. But on average, we were like 1/3 cash for 2020. And we still managed to bring in 24% returns, okay? So the way I think about it is that's that much less risk that we're taking on. So if you compared 2019's returns, which are absolute returns, which are almost the same as 2020's absolute returns of about 24%, the 2020 returns were actually far less risky than the 2019 returns based on the amount of cash that we held. And if something would have gone really bad, say in between June and January, we would have had cash on hand to invest when the market was lower, and the stocks that we owned wouldn't have fallen as much as the S&P 500 index. So I like to think of, how much cash am I holding as how much risk am I taking, and right now we're about 18% cash. So that's, less risky than the market, I think. I will say that we are invested in more highly cyclical stocks right now, and those can have a tendency to fall more during market correction. So taking that into consideration, we're not a lot more conservative than the index, more, risk adjusted, risk free than the index, but we are still in a less risky position than the index. Now, one caveat I'll add to this is this really only works if your mindset is to actively invest that cash when the market falls and when prices fall. So if your mindset of the cash is to go hide and keep it out of the market so that you don't lose money from it, while that is in practice what happens, if that's your mindset, you're probably not going to be buying the cheap stocks when they get cheap. Like in March, we bought 30 stocks in March. So if you're scared and you're holding the cash, it doesn't do you a whole lot of good. I mean, you'd probably just be better just to put your money in the market and dollar cost average or whatever. But if you have the mindset and you can analyze stocks and understand when they're cheap, then having that cash really gives you not only a bonus of having a lower drawdown a lot of times, but the bonus of having actual money to invest and buy things when the prices go down. So I really think of the cash/ultra short-term bond position as a way to measure risk. So if you look at Berkshire again, they're holding about 20% cash. And they have been because they're basically in the same position I am. Except for it's harder for them because they're so much bigger. They're waiting to buy things at prices where they think they can get a good return for their money. So they're taking on a lot less risk than the market. You'll hear a lot of Berkshire naysayers saying, they're done for and everything and, run away or whatever. Buffett's washed up. Well, no, and then they'll show the performance of the S&P 500 compared to Berkshire. we haven't really had a true recession yet. And once we do, you'll see the benefit of that cash because Berkshire's taking on a lot less risk than the wider market right now by holding that cash. And also the particular businesses that they invest in, I think, are less risky a lot of times too. So you don't really see the benefits of that until you see a big drawdown in the market. But you can still measure it by looking at how much cash they have. You can, especially when you can take a company that has a bunch of net cash and you compare it to a company that's been levering up for the past 10 years or whatever. And that's what people miss a lot. There's just a lot more risk in these other companies. Now, if nothing bad ever happens again in the world and the market never falls and we never have another recession, then, you know, you took on less risk and you'll end up getting less return out of it in the long run. But usually that's not how it works. So it's just something to think about. All right, with that, let's move into the buy, sell, or avoid section. I'm going to have a quick disclaimer, and then we'll get into those 3 stocks that we're going to cover this week. And I'll cover the returns and the relative returns of the stocks that we've had in this series the past 2 weeks. And we'll see how they're doing and how it's just beginning to shape up. We're only a couple weeks in, but we'll take a look at those too. All right, let's go. Hello, everyone, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer, and this is a channel where I share my investing process and strategies using examples of stocks that comprise the S&P 500 index. These videos are for educational purposes only and are not personal investing advice. If you would like to receive analysis on stocks that are not part of the S&P 500 index, as well as receive additional in-depth portfolio strategies, consider joining the Cyclical Investors Club premium service. It has produced market-beating ideas and strategies, costs less than $30 per month, and it helps support the investor education and research that I share with the public. With that, let's get into today's video. Okay, let's start off by looking at a couple of the buy suggestions from the past couple weeks. This doesn't tell us a whole lot about medium or long-term performance and what it will be, but I want to get in the habit of checking into this, and then over time, we'll be able to look back and see kind of how things are playing out. So, and it will also give me a chance to talk about absolute and relative performance a little bit here. So here we see Principal is up over 7%, while Anthem this past week was down 3%. So the overall performance of these two ideas is 2.5%. If you invested in the S&P 500 index on the same date, your performance, you would have lost about 0.5%. Okay, so these two buy picks are outperforming the index on average by about 2.6% or 263 basis points. Okay, so if we go to the sell and avoid stocks, which I have combined together right now in this spreadsheet, we can look at the same thing. Franklin has actually done pretty well probably because of a rotation into financials and a general assumption that their assets are probably going to go up. But that's my guess. You never know short term what these things are going to do. But if we look at the average of all 4 of these, they're just barely positive, but the S&P 500 is actually, again, about negative, about 0.5%. So even these sell ideas, because Franklin has been doing so well, are positive. Now, they haven't done as well as the buy suggestions, which are up 2%. So, or on average are performing 2% better than the index. You could also compare the absolute performance. So the absolute performance of, if you picked these 4 sell/avoid ideas, you would be about even, whereas if you pick the buy ones, you'd be up like 2%. So this is a way we can kind of measure it, look at it different angles. Not one angle is necessarily more important than the other. It really depends on what you're looking at. And I kind of like to take it in all at the same time and not just pick one specific thing. But that gives you a broad picture that, so far, even though we have only a couple picks, we're doing a little bit better than we would have done with the ones that I thought weren't as good on a relative basis. Okay, so with that, let's start looking at the stocks that I have for this week. We're going to start off with Allstate. Allstate's an insurance company. And when you look at insurance companies, this is going to be my buy for the week. When you start looking at the cyclicality of them, they can have a lot of idiosyncratic things that happen with claims and stuff that can make it a little trickier to kind of figure out, are they cyclical? Are they not cyclical? What's going on? And 2005 is a good example. So the economy was generally doing really well in 2005, but EPS for them fell 46%. I wouldn't be surprised if this had something to do with Hurricane Katrina. And that's the type of thing you might see. So if that's the case, then this isn't really indicative of how cyclical they are. Additionally, when we move on to the financial crisis, so we have this kind of unusual outperformance, we'll say right in here, and then followed by a really unusual decline. And then since interest rates were held low for so many years, we see this stagnation period here. So, and interest rates can affect insurance companies. Usually higher short-term interest rates are better for insurance companies, just as a general rule. It can vary, but just the impression that I get from looking at this is that's kind of what I'm seeing in general. Now, I would categorize this, just because I've looked at a lot of insurance companies, and I would categorize it as like a moderately cyclical stock rather than a highly cyclical stock, even though we do have this giant decline here. I don't think this type of thing has a high probability of occurring for the next cycle. We'll see some other thing that's not necessarily financially related that's going to affect it in exactly the same way. So the way that I kind of account for this to some degree, but without kind of treating it as a highly cyclical, is I decided to start this cycle in 2010. What that does is it allows me to assume that we're going to eventually, whether it's an idiosyncratic thing, whether it's a full, like a market cycle thing, I do expect EPS to suffer some sort of trauma in the next 10 years. I don't know what it's going to be. But when I build in my earnings growth calculations, I want to include this, and then I'm also going to have these stagnant years, okay, but we're also going to have good years. So it really combines all that stuff together. And I'll get to that portion in just a moment, but I like this time frame because it really captures all that. It gives you a pretty good average. It gives you what the downside looks like, it gives you what the nothing looks like, and it gives you what the upside looks like. So it should provide a pretty good baseline to estimate what the future could hold for the next 10 years, okay? All right, so we have 2010. The first thing I want to do is look at the mean reversion possibilities here. So when I calculate the current PE, I'm using 2021's earnings in this case, okay, which are actually conservative because they're expected to decline. They're lower than what the earnings are this year, all right? And when I do that, I get an 8.79 PE ratio. And then the average PE ratio for this time period was actually 11.5. So if we look at the fast graph here, 11.5 since 2010 has been the PE. So if the PE ratio, if everything else is the same, the PE ratio reverts to the average, you can expect to earn 2.72% per year just by the market changing its mind about the stock a little bit. It doesn't even have to get expensive. It only has to trade to 11.5 PE, and it can take 10 years to get there, okay? If it happens sooner than that, I mean, that type of change can happen in a year. So, I mean, you could make 27% of the stock in a year just from the PE ratio. But I like to spread it out over 10 years just so I can compare everything on that basis. So we can expect that from mean reversion if it happens. The next thing I want to look at is the business return. So this is what you would earn if you just bought the whole business and you didn't worry about the market and you just collected the earnings for yourself, okay? So if you do that for 10 years and you get the earnings plus how much the earnings grow each year, you'll end up with about a 10% CAGR from that. Now, if you look at the fast graph, it actually estimates earnings growth at 10.67%. So that's measuring from here up to here, okay? And they're saying, hey, earnings grew 10.67%. Now, the two things that I take into consideration that aren't taken into consideration there are these declines, all 5 of them, and then also stock buybacks. So they've bought back almost half of the company during this time period. They're buying back a lot of shares, or very steadily buying it back. And that will inflate the earnings per share. So if you take that into account and back those out, you get a much lower growth rate. So I'm much more conservative than a basic earnings growth rate. I'm also much more conservative than the recent growth rate. I mean, the recent growth has been like 20% for the past 5 years. So very, very conservative estimates on my part, I think. So if you invested $100, it grew at 6.29% for 10 years, you could turn that $100 into like $261. And if you plug that into a CAGR calculator, it'll give you like a 10% return from that. So if you add that to the 2.27% we would get from mean reversion, then you could expect to get almost a 13% CAGR, and 12% is my threshold for an absolute buy. So even if the market was, really expensive or whatever, this isn't just relative to the market. You should be able to get a good return if the next cycle is similar to the last one. Just taking a look at some of the other factors I look at, PEG ratio is pretty low. 3-year revenue, this is cumulative and not annual, so about 4% per year, maybe in between 3 and 4% per year the last 3 years, and positive. And that's not awesome, but really this is just a measurement to see if it's low. Once it crosses like a basic threshold, I'm fine with it, and that's perfectly fine, and it's in line with this, okay? Pretty close to being in line with it. This is obviously much longer term, and this is much shorter term. PE, so it's trading near a PE that it typically trades at in recession times. So it, and you can just look at the PE and see that it's an 8 PE, but every now and then you'll have a 9 or 10 PE stock, and during recessions they might trade at a 5 PE. So these could still have a lot of downside sometimes. Now we're also early cycle, I think, now, so this measurement isn't as important as others, but it's worth knowing that it just looks good. So the shareholder capital return, what this is how much they're returning to you in dividends and share buybacks the past 3 years compared to the earnings yield. So about 60% of their earnings they're returning to shareholders in buybacks and dividends. What I like to do is compare this number to the earnings growth. So if they're keeping 40% of their money and reinvesting it in their business or paying off debt or doing whatever, I want to see some growth occurring out of that. And we do. We see 6% growth, which is okay. It's not great. You're not getting like a super awesome deal here, but really what I'm looking here is anything strange. I mean, do they have a low growth rate and then they're not giving money back to shareholders? Because if that's the case, that means they probably have to put a lot of money into their business in order just to keep it steady basically at what they're earning right then. And it could be a warning sign. Okay, so that's my case for Allstate, which is the buy this week. The sell is Estee Lauder. Let's take a look at Estee Lauder. Now, just to review, sells are stocks that are high quality but expensive, or they have some other weird thing potentially going on that you'd want to avoid. But mostly they're high quality companies, and if they were just trading at the right price, they'd be fine. But given the price that they're trading at, they're too expensive. And actually, sometimes fast graph can exaggerate slightly because it's not a logarithmic scale. And when you look at a 20-year time period like this, but you can just tell by looking at it, it's really diverged from its average PE ratio. And it doesn't even really match earnings here because they got hurt during this last COVID recession. Now that might not repeat the same way, just given everybody was at home and maybe didn't want to wear makeup or whatever anymore. But it's worth noting that it doesn't really match reality very much, in my opinion. So let's get into how I would look at this one. Let's see here. 2012 is where I decided to start this time frame. And again, the goal with these time frames is just to make them reasonable with what you expect the future might be. I mean, I always try to include one recession. So looking at this, we have good growth, blah, 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 blah. And then we have this recession dip here. And if we look back, it's actually, if I remember correctly here, just take a quick. They actually got hurt worse in the last recession, okay? So we shouldn't assume that this would never happen again. It looks like a pattern. Usually they grow, but when economic times are tough, then they usually don't grow. They usually shrink a little bit. So let's see here. First thing we want to do, look at the mean reversion. So we have a 28.63 average PE ratio during this time period. And the current PE I have is 39.23. Okay, so let's look at that. So you'll notice that is lower than the fast graph. All right, and the reason that is because I'm being very generous and I'm using mid 2022 earnings of $6.35 per share. So I'm assuming they're going to recover just as expected here, and then what I'm going to do is measure after this what I think the growth rate will be after that. So I'm being very generous in assuming all this kind of goes as planned. Whereas fast graphs is probably blending current earnings in this, so they're going to be somewhere down here. So rather than a 52, I think it's more reasonable to be more generous with them and say they have about a 39 PE. But if it reverts from a 39 to a 28, you're going to lose about 3% a year over the course of 10 years just from the market changing its mind to its average feeling about the company. Okay, now let's move on to the business CAGR. And there I have 10%. They haven't bought back many shares, so this isn't too hard to calculate really. They have one downturn to take into account. The current downturn was actually shallower than the last recession. So I have about 11% growth. We'll see what Fast Graphs has. They have about 12. That logically makes sense. I took into account this year, and I took into account this year, and I took into account the small amount of buybacks that they did have. So my growth rate was, just a little over 1% lower than theirs. And that all makes logical sense. Sometimes you just like to look at it, see, does it make kind of basic logic sense? And yeah, it does. Okay, so 11%, they're growing faster, obviously, than Allstate. But the stock is so expensive that if you invested $100 and bought the whole business, and it grew at 11%, grew earnings at 11%, you'd make about 4% a year from the business. Okay, so you're earning something. It's not that you're not earning anything. But if the sentiment reverts, you're also going to lose 3%. So when that all combines together, you're only going to earn about 1% a year if these estimates kind of are close. And if this gets too far under 4%, I start looking to sell. So, and it looks like, I don't want to make any short-term predictions here, but it looks like the momentum could be shifting down. Where were they at? These are monthly measurements, so yeah. So definitely, if I own this, I would have a trailing stop on it. I would be looking to take profits up here so that it doesn't revert down here. If it drops from where it's at now, 250 to 150, you're going to lose a lot of money. So yeah, Estee Lauder, high quality. I expect their business to do well, but they're too expensive. All right, let's move on to the third one. This would be the avoid. So avoids are stocks that I think have where the numbers could look good, but there's some other thing going on where I think you should just avoid the stock because there's just too much danger because of whatever else the other thing is. I have a bunch of them that I look at. In this case, I have high debt highlighted, but I would also add that Illinois Tool Works is kind of a double whammy because they're also very expensive, if I remember correctly. Let me pull this back up again. I've written on them before a couple years ago. All right, here we go. Yeah, so they are pretty expensive. Again, this is not too much different than Este Lauder. We have a 31 PE that is based on these depressed earnings, okay? And we'll do all the calculations here, but just the basic pattern is we're near all-time highs. The basic PE we're looking at looks pretty high, okay? But the issue that I have, and I realize that interest rates are low, okay, but when you're thinking about 10 years into the future, you need to think about things that can go wrong, and maybe not things that are going to like destroy the business necessarily, but just suppress earnings, make it harder for them to grow, and things like that. And high debt is usually the first thing that comes along. And I even added a couple columns here to take a look at this. But first, let's look at these basic things. So even before we get into that, using forward earnings, okay, the PE is 26. That would be, I think I use these recovered earnings from 2021. So I'm going to assume that they're able to do this. I wasn't so generous that I went out 2 years, but I went here. And that lowered that PE from 32 almost down to 26. But even then, the average PE is only 21.68, and you would lose a couple percent a year just if the PE reverts to the normal, okay? They have bought back some shares. By the way, the time frame that I used was 2015 for this. So I can use 2015 because there was it just seemed more representative of what we had going on before the downturn. Pretty steady here in terms of EPS growth. So, and then you can see the PE here, and they expected a 7% growth rate, which we'll get into in just a minute. So they did buy back about 17% of shares and over not so long a time period. And once I took those into account, my growth rate was just a little bit lower than Fast Graphs because I went ahead, I think what I did, and I assumed that there was going to be a recovery. So I gave them credit for this year here, and that I included that in their growth rate expectations as well. So even though I'm a little bit lower than Fast Graphs, if I just had the share buybacks included, it probably would have been a little lower than this too. So I think I was more than generous when it came to these assumptions. And so if you invested $100 over 10 years, it would turn into 157, and that's like a 4.6% growth rate. Combine that here, and so even if we don't take into account the high debt, all right, we're only looking at like a 3% return per year over the next 10 years. So that alone, honestly, would be enough for me to sell the stock or put a stop on it. But with the high debt, which I think I put in here we go. So let's look at the debt to equity here. I don't usually track this in spreadsheet, but I thought it might be useful here. I have two basic factors that I look at when I start considering debt. One is the debt to equity over 1.0? Okay, that's the first question. If it's less than that and everything else looks good with the stock, then I don't get too worked up over it or too worried about it. Once it gets over 1, and we can see theirs is triple that, okay? Their debt to equity is almost 3. Then a red flag goes up, and I say, okay, well, for some businesses, it's just normal for them to carry high debt. If you buy like a tobacco company or something like that, they carry lots of debt, and that's just normal. So what I do is I go back and I look at what has the change been this cycle from the beginning of cycle to now? Is the trend up, or are they just taking on more and more debt? And that's exactly what's happened. So these guys have 170% rise in their debt to equity since 2015, I think is when I started this. Yeah. So we have both of the warnings going. You have a high debt to equity. You have a big change in the amount. Okay. And I would also say that there's some capital allocation questions that are raised when they have all this debt and they're buying back shares. They're probably paying a dividend too. Let's check. Dividend yield about 2%. So yeah. So they're basically borrowing a lot of money and then just handing it over to shareholders, and they're only growing at 7%, so it's just a lot of stuff. I doubt it will fall off the face of the planet, but this is one that unless something changes, you're probably not going to get great returns. They're probably going to return less than the S&P 500, and probably not going to give you good absolute returns going forward. So this is my avoid for the week. I think that's all. Thanks for watching, and listening and thinking about how to measure performance this week. And I'll come back next week and we'll see how all these are doing, and I'll have 3 more buy, sells, or avoids. If you haven't subscribed to the channel, make sure to go ahead and hit the subscribe button and consider joining Cyclical Investors Club Premium. It's only it's less than $30 a month. If you get an annual subscription, it's even less than that. It's closer to like 25, I think. And there I cover basically the entire universe of stocks that I feel I can adequately analyze. We track about 500 or so stocks in real time, and not just the S&P 500, but everything else. We produce good returns and haven't taken on nearly as much risk as the market, I think. So consider that. I'll have a link in the description, and maybe consider checking that out. It helps support basically everything that I do here. Until next week, later.